As the full impact of President Trump's tariffs start to sink in, Americans are anxious.
I'm definitely nervous. I think the cost of everything, living is already high.
I just worry, and I want it all to be over with.
You might have heard this advice: don't look at your 401k.
Take a deep breath and keep it all in perspective.
But it's hard not to, right? 62% of U.S. adults own stocks, according to Gallup. So what are we supposed to do? Well, a lot depends on where you are in your life and what your appetite is for risk. For people in retirement or close to it, that's hard.
I looked at my 401k this morning, for example, and in the last 2 days, that's lost $58,000. That's stressful.
Folks like Victor Fettis, who just retired last week, built up savings for years for this moment and now relies on those investments to just pay the bills.
That's not a maintainable trajectory for me to stay retired.
And it's not just those in or approaching their golden years who need to tap those investments. Maybe you're about to send a kid to college or put a down payment on a house or start a renovation.
There is safety out there for the time being. You don't need to stay in stocks.
For example, buying Treasury bonds can get you between 3 and 4% return every year. Same with CDs or money market accounts. And that can look very attractive when the markets, the stock markets, are so unstable. But selling out of fear could mean you miss a potential bounce back and the returns that come with it. Here's the market crash during the financial crisis that caused the Great Recession. From the high in October of 2007, it took 17 months for the Dow to drop more than 50%. And then it wasn't until March of 2013, years later, that the stock market finally recovered. But sometimes things bounce back much faster, like in the pandemic, when it took only about a month for the market to lose a third of its value, but then only about 9 months to fully recover. This morning, Morgan Stanley's wealth management team put out this note, very pessimistic about the potential impact of Trump's tariffs. But even so, saying, quote, we are apt to take more of a wait-and-see approach, avoiding knee-jerk panic, because things can change over the next 90 days. Which is why, if you're in it for the long term, just starting your career or a family, experts say keeping a steady approach to investing is key. Don't let your emotions get the best of you.
Over the past 5 years, the stock market is up over 110%. That is a very large rate of return for the stock market. And if you stayed invested through the pandemic, you've been able to see your investments compound over time in a way we haven't seen in generations.
Keeping in mind it could get worse before it gets better, which has been the messaging from the White House.
We may have short-term a little pain.
For those looking to buy a home, while interest rates are falling, which could help affordability, the economic uncertainty could keep buyers on the sidelines. At the end of the day, it's important that you know what you need to pay your monthly bills, what your risk tolerance is, and your investment time horizon. And consider working with a financial advisor to make sure you're set up for whichever way the economic winds might blow. Yeah, you know, there's an old adage on Wall Street that trying to pick the best moment to buy into a market like this, it's kind of like trying to catch a falling knife. You almost certainly will draw some blood.
Thanks for watching. Stay updated about breaking news and top stories on the NBC News app or follow us on social media.